The latest U.S. jobs report showed an unexpected decline in payrolls, yet the stock market is back at record highs. So what is the market seeing that many investors might be missing? Hello, I'm Eric Pettway, Chief Investment Officer at Journey Advisory Group, and welcome to CIO Corner. The stock market had a strong week, with the S&P 500 rising 3.5% and the NASDAQ 100 gaining 5.1%. The S&P 500 and Dow Jones Industrial Average returned to record highs, while the NASDAQ is now within roughly 1% of its all-time high. The S&P 500 is up approximately 14% year-to-date. International stocks trailed U.S. markets last week, although developed international markets continued to outperform U.S. equities for the year. The biggest story last week was the July jobs report. Payrolls declined by 23,000 jobs, which was well below expectations. While the unemployment rate edged down to 4.1%, labor force participation fell to 61.4%, its lowest level in more than 5 years. Investors view the report as a sign that economic growth may be moderating, helping push interest rates lower and easing concerns about additional Federal Reserve tightening. Looking ahead, inflation will be in focus as investors watch this week's CPI and PPI reports for clues about the direction of prices and interest rates. At the same time, earnings season continues to be a bright spot. According to FactSet, the S&P 500 is currently on track to deliver year-over-year earnings growth of 50.4% for the second quarter, which would mark the strongest earnings growth rate since 2021. Now it's time for our chart of the week. This week's chart focuses on the labor market, one of the most important indicators of economic health because employment trends often influence consumer spending, business investment, and Federal Reserve policy. The jobs report raises questions about whether the labor market is beginning to slow more meaningfully. While hiring has moderated and participation has declined, unemployment remains relatively low, and broader indicators continue to suggest layoffs are not widespread. The key takeaway is that the labor market appears to be softening, not breaking. Growth is cooled from the exceptionally strong pace of recent years, but many areas of the economy continue to show resilience. That's an important reminder that while markets often react to short-term headlines, long-term investors are typically better served by focusing on broader trends rather than any single economic report. Thank you for spending a few minutes with us today. If you found this update helpful, be sure to follow Journey Advisory Group for more market insights and investment commentary. And if you have questions about your portfolio, financial plan, or overall investment strategy, we're always happy to help. As always, remain calm, stay focused, and most importantly, stay the course.